last but not least, when we're talking about financial analysis, is the ratio analysis. Ratios can be classified as liquidity ratios, solvency ratios, or profitability ratios, where liquidity measures the short-term ability of a company to pay things like its maturing obligation, meet its unexpected needs for cash, and have adequate liquidity for operations. Solvency is a measure of ability of a company to survive over a period of a long time. And what is that likelihood to happen going forward into the future? Profitability ratios are the measure of the income or operating success of a company for a given period of time. A single ratio by itself really doesn't tell us a whole lot. Where the value in ratio analysis comes from is in seeing how ratios change or in how they are related to each other, and how can we impact that ratio by making changes to our operations or to our investments and yielding what we need it to be. How do we make that happen? Well, we may have to cut down on some expenses, or we may have to generate more sales, or we may need to have less investment or more investment. There's all different ways you can do that. And you can do that intra-company by looking at 2 years, 1 year to the other year, 1 quarter to the other quarter. You can do industry averages, so compare it based off a median ratio for the industry as a whole, or intercompany. So, for example, we could just compare us and our largest competitor. So when we're doing ratio analysis, we're going to use both an income statement and a balance sheet. We have the condensed statement of cash flows because there's some that actually relate back to this as well. And you notice that we have 2 years on all of these. They're all comparative. With liquidity ratios being the measure of the short-term ability to pay its maturing obligation and to meet their unexpected needs for cash, we have several ratios. Short-term creditors, such as our bankers, our vendors, our suppliers, they're really interested in liquidity because they want to make sure that we can pay them back. The current ratio is a widely used measure for evaluating a company's liquidity and the short-term debt paying ability. It is computed by dividing current assets by current liabilities. For Chicago Cereal, when we take their current assets and divide it by their current liabilities, it is 0.67, which is 67 cents of current assets for every dollar of current liabilities. 2019, it was 60 cents. We have increased the amount of current assets for every dollar of current liabilities by 7 cents. The industry average is $1.06. As you can see, Chicago Cereal is running a little bit low. However, they are on par with their biggest competitor, Giant Mills. So when we look at it from different perspectives, while compared to the industry, we may not have as much, as compared to our biggest competitor, we are performing in the same way. The accounts receivable turnover is used to assess the liquidity of accounts receivables. Companies compute this ratio by dividing net credit sales, or net sales, if it does not say specifically what the net credit sales are, by the average net accounts receivable. The average collection period in days is computed by dividing this ratio by 365. This is a measure of the number of times on average the company collects receivables during the period. So if you take that and you divide that into 365, that's going to tell us about how many days it takes. Analysts will frequently use the average collection period to assess the effectiveness of companies' credit and collection policies. As accounts receivable can be a significant portion of a company's current assets, it's important that they are managed effectively. The inventory turnover measures the number of times on average inventory was sold during a period. Companies compute this by dividing the cost of goods sold by the average inventory during the year. The days in inventory is computed by dividing inventory turnover into 365 days. The faster your inventory turns over, the less cash is tied up in the inventory, and the less chance you have of your inventory becoming obsolete or something else happening to it. Days in inventory tells us the average number of days of inventory that is held. Solvency ratios, which measure the ability of a company to survive over a long period of time. These include the debt to assets ratio, the times interest earned, which both provide information about debt paying ability, but it also has free cash flow, which is information about the solvency and the ability to pay things like additional dividends, invest in new projects, be able to take advantage of an opportunity when it arises. With the debt to assets ratio, we're measuring the percentage of total financing provided by creditors. It is computed by dividing total liabilities, both the current and the long term, by total assets. This provides some indication of the company's ability to withstand losses without impairing the interests of its creditors. Times interest earned, which is also called the interest coverage ratio, indicates a company's ability to meet interest payments as they come due. It's computed by dividing the sum of net income, interest expense, and tax expense by the interest expense itself. It provides an indication of whether or not the company is going to be able to meet interest payments as they come due. How many times could we meet that? Here we see that Chicago Cereal has a 5.8 in the current year. They were previously a 6.0. The industry average is 5.5, so Chicago Cereal is covering it better than the industry average, but not as well as their biggest competitor, Giant Mills, who's at 9.9. Free cash flow is an indication of a company's ability to pay dividends or potentially expand operations. With free cash flow, we are able to take advantage of opportunities when they arise. This is the remaining cash from operating activities after we deduct the capital expenditures and dividends paid in a given year. Profitability ratios are a measure of the income or operating success of a company for any given period of time. Income is going to affect how a company is able to either obtain their debt, their equity financing, their liquidity, their ability to grow. It really does have an impact everywhere. Creditors and investors are going to be especially interested in evaluating your profitability because if you are not profit, you are not going to be able to generate enough income to cover interest and pay back principal loans. Often, analysts will use profitability as the ultimate test of the operating effectiveness of the current management. Here we show a variety of different profitability ratios where we've got the return on common stockholders' equity, which is a factor of the return on assets, leverage, then you've got profit margin, and your asset turnovers. This is how everything is tied together in ways that you may not have previously seen. So starting with our return on common stockholders' equity. Here we see how many dollars of net income the company earns for each dollar that was invested by the owners. Companies compute it by dividing net income less preferred dividends, and we divide it by the average common stockholders' equity. This is going to show how many dollars of net income the company earned for each dollar that was invested by the owners. An overall measure of profitability is return on assets, with this ratio being computed by dividing net income by average assets. Leveraging or trading on the equity at a gain is borrowing money at a lower rate of interest that can be earned by using borrowed money. Profit margin is a measure of the percentage of each dollar of sales that results in net income. It's computed by dividing net income by net sales. Here we can see that Chicago Cereal has a profit margin of 9.4%, which is up from 2019 at 9.2%. This is greater than and performing better than their competitor Giant Mills at 8.2% and well above the industry average of 6.1%. Asset turnover is a measure of how efficiently a company uses its assets to generate sales. It's computed by dividing net sales by average assets. As you can see here, if we take profit margin times asset turnover, then we get the return on assets. And here we have the formula for each of those. So if we take net sales and we reduce those out because, when you cross multiply, and we get 10.1%. Gross profit rate is an indication of a company's ability to maintain an adequate selling price above its cost of goods sold. It's computed by dividing gross profit by net sales. Chicago Cereal is holding steady at 44%. This is in excess of Giant Mills at 34% and the industry at 30%. So Chicago Cereals is really doing well at this particular juncture. Earnings per share, which is also evidenced on your income statement, is a measure of the net income earned on each share of common stock. It's computed by dividing net income minus any preferred dividends by the weighted average number of common shares during a given year. The price-earnings ratio is a measure of the ratio of the market price of each share of common stock to the earnings per share. It's computed by dividing the market price per share of the stock by that previously calculated earnings per share and is an investor's assessment of the company's future earnings. The payout ratio is a measure of the percentage of earnings distributed in the form of cash dividends. That's what our stockholders would love. It's computed by dividing cash dividends declared on common stock by net income. Now, we have really looked at quite a few things here. We've looked at ratios, we have looked at horizontal analysis, we have looked at vertical analysis. We'll continue to look at these even more as we move forward. And as you move into working on your ratio, your CFA analysis. But this is just to get your feet wet. I will be introducing you to more and more ratios throughout the term.